Hello, everyone, and welcome to today's Fab Profits Macro webcast. Appreciate you all joining us today. So today, this will be hosted by myself, Matthew Phillips, and our founder and CEO, Angus Geddes. Thank you for joining us, Angus.
Thanks, Matt.
So just before we kick off, just a bit of housekeeping. So everything that is provided today is on a general advice basis. So before you make any decisions, please consult with your financial advisor first. And as always, past performance is no indicator of future performance. Okay, now let's get into this. So if you guys have any comments and questions, as usual, for anyone who's been here before, please just put them into the question box here and we will answer those at the end. And if you can't hear the presentation, please check the volume on your PC. This is more for people who can't see it or hear it right now, or give us a call. Okay. All right, so let's kick this off. So I thought one of the first things we could touch on, Angus, there's a lot of noise coming out of the US at the moment. I thought it'd be worth looking at the S&P 500.
Yeah, so Matt, look, I think it's probably fair to say that, the S&P 500 really has hit up against fairly stiff sort of resistance level above record highs at 6,100. And we've been sort of saying for a while, I think that, valuations are pretty stretched. Mag 7 stocks and technology growth stocks are also very, very expensive and at the top of their historical ranges. And, I think we're getting a bit of pushback now from investors in that market. I mean, you've got crowded positioning in those tech names. You've got valuations that are very expensive. And whereas, probably in the last sort of year or two, the NASDAQ has run higher on multiple expansion, the average PE in the NASDAQ has gone up. Now what the market really needs to see is for the sort of anticipated earnings growth coming through. So we really need to see that in upcoming quarters. Now, the US economy is still very resilient. There's a lot of momentum over there. And so I think, the bull market has got further to run. But, our call, a couple of weeks ago that the US market needs to consolidate, needs to work off some of those overbought conditions and correct some of that crowded positioning. I think, that's all proving to be quite valid. So, look, I see the S&P 500, bottom line, I think the S&P 500 will go sideways. It'll probably correct sideways and range lower within a range, over coming months, until we get a bit more clarity on where earnings are going and, companies are delivering.
Yeah, perfect. And you said you mentioned in there the Mag 7. So we have seen across the Nasdaq a bit of profit taking there. They've been on a fantastic run, but I thought this was worth having a look at, that rotation, as you said, out of the Mag 7 and AI.
Yeah, look, that's why I'm sort of quite comfortable with the overall equity market in the US and certainly overseas. All we're really seeing is rotation. The Mag 7 names account for 30% of the S&P 500, big chunk of the NASDAQ. And so, there's nothing untoward really from a trending market that then consolidates and goes sideways for a bit. If we look at the NASDAQ composite, this rotation is clearly going on now beneath the surface. We're seeing some of these other sectors which lagged in the US, such as the financials and some of the cyclicals and industrials benefiting from the investors, rotating out of some of the more overheated stocks into some of the other cheaper pockets of the market. So I think that's going to continue. But what we've also seen, which has surprised quite a few people, is the strength of some of these undervalued international stock markets we've been talking about. The likes of Germany's DAX, the Euro stocks, certainly Hong Kong and China. We've seen those stock markets really take off and rally to new highs. So yeah, a lot of rotation. I think that's going to continue. And I think that provides a favourable backdrop for international equities. And whilst the US stock market is in for a period of consolidation. I don't think it's going into a bear market. I just think that the bull market is going to have a healthy pause for the next several months, before perhaps the rally picks up momentum later in the year.
Mhm. Yeah, and we've seen a bit of movement in the bond market as well there, Angus. So you can see here on this chart, everyone, we're looking at the US 10-year. What are your thoughts on this?
Well, I was quite worried about the bond market. A month ago, when the yield got up to up towards sort of 4.6, 4.7%, I was worried about it because, if the bond market breaks down and it ruptures, and we see the yield on US 10-year run away to 5% and take out those 23 highs, that's not good either. A higher bond yield puts pressure on equity valuations and makes the stock market look more expensive. So it's been good to see the 10-year bond yield backing away. So we've seen a decent rally. Now, we don't want to see the bond market rally too much and yields fall away, back to 3% kind of thing, because that's a dog with different fleas. Then that would send alarm bells that the US economy is in real trouble, that rate cuts are on their way, that there's economic downturn approaching. So what we really want to see is what the bond market is doing at the moment, where we've seen a decent rally. 10-year yield has moved down, but so has the 2-year. And what we really want to see is a positive upward sloping yield curve, which indicates a healthy economy. So so far the bond market is behaving, and that's a good thing.
Yeah, and one of the other things we've seen coming down off those recent highs is the US dollar index. So we saw it getting up to about that 110 mark there, as you can see on the right of the chart. Do you think this pullback is going to continue?
Yeah, first of all, I've got to say, a lot of the Trump trade that we saw post the US election in November last year, a lot of that has unwound. We saw Bitcoin run from 65,000 up to 110,000, for example. We saw the US dollar run away to the top side. The dollar index got up to 110, quite overvalued. We saw a lot of the perceived beneficiaries from Trump coming in, such as Tesla. It got to $480 a share. It's now given back about half of that, or a significant chunk of those gains. So, look, it's probably fair to say that some of this over exuberance, if you like, has been unwound, and I think investors are now sort of looking at the Trump administration on probably a little bit more on a day-to-day basis, but no longer sort of through rose-tinted glasses, but probably taking a bit more of a realistic view. Now, just on the dollar, the technical setup for the dollar index is by no means bearish. This is a bullish breakout that we saw. It got through 106. It ran away to 110. It's had a pullback. It's retraced pretty much half of that move, or a third of that move, since October last year. And so technically, it's not looking bearish at all. It's still looking bullish. But as you'll know, Matt, and a lot of our members will know, I am a US dollar bear, and I think that Trump has got to be quite careful in terms of how they implement these tariffs. If they go too hard on the tariffs, it could backfire. It could put upward pressure on inflation, which in turn puts upward pressure on interest rates and bond yields. It's going to mean that the US finds it more costly to roll over its funding for its deficit and its federal debt, which it's pushing up towards $38 trillion. There's a lot of noise about Doge getting in there and cutting costs and cutting out excess spending, and I hope they succeed. and for all I know, they might be quite successful on that front. But history shows us that it's quite difficult for governments, any government for that matter, to wind back entrenched spending programs, especially when it comes to Social Security and Medicare and that sort of thing. So anyway, look, I think we'll put the dollar on the sidelines for now. But if I am right, and the US dollar does weaken into the second half of this year, and I think the US exceptionalism trade has run its course. I think we've seen peak sort of bullishness about the American economy. And, I think we'll see other countries and other stock markets do a lot better this year in a relative sense. We've already seen Europe, the UK, and China, Hong Kong do much better and outperform the US stock markets this year. So I think that's going to continue. And, the flip side, of course, is, with the currencies, anyone going to Europe or traveling anywhere outside the US would be thinking that the US dollar goes a long way and the rest of the world's so cheap. Well, the flip side to that is the US dollar is actually, as a currency, I think, is very very expensive and overvalued. So I think we're going to see lower levels later this year for the greenback.
Yeah, right. And then another area that we've seen a lot of people going into, I can actually see a few of the questions in here from the members as well, is talking about gold, which has just continued to hit these record highs. I know this is an area that you've been very bullish on for a long time, so I thought it'd be good to cover this one off.
Yeah, so the US election was quite defining for financial markets. Certain sectors and currencies, the US dollar for one, took off. The Aussie fell. Most currencies around the world declined, and gold also got knocked around, as did the precious metals and a lot of commodities. But it's good to see that gold has got back on its feet. It's in this consistent bull market, and it's pushing up against the record highs. I think what's notable in recent weeks is, we know that the central banks have been a driving force in the spot market for some time, but we've seen a lot of institutional and retail buying pick up. The flows into physical gold ETFs has really accelerated. So it's really good to see the bull market spreading and becoming a bit more balanced in terms of the drivers. So look, I think gold is still in this uptrend, and we'll probably see the $3,000 level challenge not before too long. At some point it's going to flatten out, it's going to have a consolidation, but I don't think we're quite there yet. And of course, gold stocks, not just in Australia, but the UK, the United States, other markets around the world, Canada, they've all lagged. They've done well, and they've recovered from that post-US election sell-off, but they're still screening cheap compared to the free cash flows and earning power that they're now demonstrating. So, and we know that the precious metal equities are fairly undervalued around the world. They don't make up much of a percentage of the average portfolio, if at all. So I think that sector is going to keep outperforming this year. And I think it won't be too long before we'll see silver also reassert to the top side. It's going through a consolidation. I don't have a chart to put up of that this week. And of course, Matt, you'll know that I think a big breakout is coming in platinum at some point this year, and that continues to consolidate quite nicely.
Yeah, and look, talking about silver, we might not have the silver chart, but I know there's one stock that you wanted to talk about, and it's got quite a good exposure, which is Coeur Mining. So it looks like it might be becoming a very good opportunity.
I've actually spelt that correctly. It's C-O-U-E-R, Coeur Mining. Look, it had a nice sort of corrective sell-off from sort of $7, and I've really put that down to some of the blame was about the profit result, listened to the interview with the CEO and went through the result, and there was nothing really untoward in that result. The company's actually really upbeat about its future prospects. But as we can see, this dotted red line, this primary downtrend is pretty formidable. It actually extends back even earlier than 2016. So quite formidable resistance. So Kerr's had a bit of a pullback. I think a lot of that's unwound now. And, at some point we'll see it reassert on the top side. The catalyst, well, I think if they keep, delivering on the cash flow front, that will be positive. But obviously the silver price, if we were to see the silver price sort of, break out and move beyond $32, $33, I think that would turn the Kerr around quite quickly. And of course, our sort of base case technical view is that Kerr Mining is going to break this downtrend on the top side, and where it's got, if it can do that, it's got significant recovery potential, which of course is our base case. So I thought that was worth highlighting today, Matt.
Yeah. No, and I think that'll be interesting to see if that silver price can help it push through. I mean, that's a pretty significant downtrend over a number of years. All right, I wanted to move on next to an area that we've seen a bit of talk from Trump even yesterday about potentially investing into China, which gave the tech stocks a bit more of a boost. And this is something that you've been kind of mentioning to our members for quite some time. So thought we'd throw the Hang Seng Tech Index up there.
Yeah, it's been encouraging to see this bull market really gather momentum over the last 6 weeks. The DeepSeek announcement was pretty significant. The fact that Xi then had a meeting with all the major CEOs of all the tech companies, I mean, that was pretty positive and represented a 180-degree U-turn from that regulatory crackdown of several years ago. So, obviously the tech sector is at the center of the Chinese economy. The government over there now sort of sees it as a key cornerstone for the economy, and in terms of not just stabilizing the economy, after the property market downturn, but really becoming a key driver of future economic growth. So, it's good to see that the government are now prioritizing that. And of course, and I was stressed this point for many months, probably a year, that Chinese tech stocks valuations are really cheap compared to US counterparts. So we've had this really powerful leg up. The index has surged from 4,200 to 6,000. It's almost a 50% move. It's going to have a pullback at some point, but it'll just be that, a pullback and a consolidation. And I think this bull market has got a ways to go, given that the bear market took 5 years to complete, and for that cycle to terminate. And interesting to see that a number of China bulls, well, a number of brokers and investment banks becoming a bit more bullish on China and Hong Kong and Chinese tech stocks and just the economy generally. But a lot of investors are still sitting on the fences. A lot of fund managers have been caught completely by surprise in terms of the speed of the rally. And, it's still very much under-owned as an asset class. So I think we're going to see, rising return on equity, better returns for shareholders, ongoing share buybacks, and still low valuations drive all those major China benchmarks higher this year.
Exactly, yeah. And we've even seen I saw one of the hedge fund managers the other day saying he's buying anything and everything Chinese. So we're starting to see the market kind of follow along from what you've been saying for quite some time. I thought we'd just pull this back. Yeah, sorry.
That was David Tepper of Appaloosa. And he made a fair point, and he sort of went in boats and all when we did. This was last year, and really upped our weighting across our portfolios. It's also good to see, some of these other old sages of Wall Street. Howard Marks was also very vocal about being bullish on China. So it just goes to show, when these turning points arrive, these inflection points arrive, You know, the rallies can be quite powerful. And, you know, when everyone's sold and selling has exhausted, you know, the path of least resistance is up. So a lot of people that were skeptical, a lot of investors that were skeptical about China will probably remain on the sidelines for some time and just watch the market continue to go higher. Not dissimilar to what we saw with the US stock market coming out of that bear market low back in 22, not dissimilar to what we saw in Japan several years ago. I mean, this is what happens when bear markets terminate and a bull market begins. You know, in the early stage, in the first innings, you know, investors typically are really skeptical, and of course, you know, that's what you need to see. That's really a tailwind that provides the foundation for those markets to move higher.
Okay, and look, I thought we'd just pull this back a little bit on the same area. So the Hang Seng Index, you know, we've seen this as well breaking out. We've seen it have two bit of, I say consolidation last time, but it's broken out again on that massive jump up to that 23,787 there on the right hand side.
Yeah, it punched through that 23,000 resistance level. I was a bit surprised actually at the magnitude of that. You know, I thought the correction was on, Matt, you know, earlier this week, you know, when we saw the NASDAQ Golden Dragon Index off 5 or 8% in the US, but we saw an outside day on Monday. The index opened up, the Hang Seng opened up down and then finished well off its lows. So that says to me that, you know, this theme has really got legs and these markets can move higher. You know, I'd like to see a bit more consolidation above 23,000, but that certainly looks like it's going to become the new floor and support level for that market.
Mm-hmm. Yeah, and look, there's some great stocks in our portfolio that we've been looking at, and one of the ones I know you've been talking about consistently is Alibaba, and we can see it's still well down from those highs back in just towards the end of 2020. Do you think this has the potential to kind of ride it all the way back up to those highs around that 300 mark? I think it is.
I certainly do. You know, it got down to a multiple of 8, which is really unheard of for a major technology company sitting at the center of the Chinese economy. So yeah, no, I think this is confirmed in a major important inflection. The bear market is over. It's still 70% below the record highs, so the recovery potential there is significant. And of course, you know, the deep seek, the fact that the Chinese technology sector has developed a workaround to the perceived AI lead that the US tech sector had. I think that's significant. You know, Alibaba is going to pour a lot of money into building out their AI capability and developing that in the cloud, etc. So you know, I think this is all pretty positive. I should say, you know, the previous chart, Wolf at the Door, and I put that on as the title for the daily this morning. What I'm really talking about there is, you know, it's really a play on the boy who cried wolf. So many economists and strategists remain completely unconvinced that the Chinese government will go anywhere near towards delivering the right amount of fiscal stimulus to really put a floor under the economy and target consumer spending. You know, the Chinese consumers have the highest savings rate in the world, up around 40% of household assets. So, you know, to really get the economy moving again and to push back on those deflationary headwinds and put a floor on the property market, they've really got to get the consumers spending again. To date, they've relied on exports. But if they can get consumption, domestic consumption moving again, that will be a very powerful tailwind for the economy. So, you know, I'm looking for a right-sized, I'm not going to say a bazooka, a right-sized fiscal response package to be delivered sometime in March and April. That the market goes, yes, that's enough, they've done what they needed to, and that then provides a support for the bull market and Chinese stocks, and you know, obviously a big support for the economy. So that's what I'm looking for. You know, will they fire a bazooka? Like, I don't know. but I don't think what they deliver is going to underwhelm. And we've just seen too much happening on the on the stage, if you like. Chi meeting with all the technology leaders. We've had pledge after pledge since September last year. They'll do what it takes to turn the economy around, that they're going to target the consumer. So yeah, I think that's coming, and that will provide a tailwind for the Chinese stock market into the end of the year.
Yeah, so it'll be interesting to see how that comes out next month. Now, I wanted to move to another one that you mentioned in the daily this week. I'm not sure how many people have been keeping an eye on it, but it does look like a good opportunity. So Budweiser APAC.
Yeah, so with the crunch and consumer spending, obviously the appetite for, buying Western beers, Budweiser, Corona, Stella Artois, to name a few of their brands, obviously sales went backwards, revenues went backwards, and so did profits. So this company listed about 5 years ago, and it's been in a pretty well-defined downward trend, Matt. But we saw quite a good breakout yesterday. They came out with a profit result and guided to better future earnings. And if we're right on the government really targeting the consumer spending, we're going to see discretionary spending on consumer items such as beer, etc., pick up significantly. So I think the recovery potential for Budweiser is pretty good. We also like Yum China, and I put that stock up, I think, in our last webinar. That's the KFC operator in China. 11, 12,000 stores, and they've consistently grown throughout the downturn in the economy. But so this is probably another one that I think looks pretty interesting, at these levels, given that we've had that big breakout from that primary downtrend.
Yeah, really interesting. So it'll be good to keep track of that as we go forward. Now, moving on to the resources, I know I can see a lot of people asking questions in this space. We thought copper might be a good place to start, considering the kind of movement we've seen over the last few years.
Well, Matt, we've been bullish on copper for some time now. It had that really nice technical breakout from a converging triangle last year. We saw copper sort of run from 360, 380 all the way up to 510, 520. It had significant resistance above that level, and it's pulled back, but animal spirits are now beginning to stir once again. What's been the catalyst? Well, overnight, we heard from Mr. Trump, President Trump, that an investigation has begun into the copper market in the United States. Now, the US produces a lot of copper, but it consumes a lot more. And so they're relying on imports. Now, if the Trump administration come back with not just tariffs on imports of copper, but restrict domestic supply of copper going outside the US, yes, they will shore up what is a valuable commodity. And as the president said, it's integral to the national security. It's vital, not just to the electrification of the United States, but also the military. But I think this will put more upward pressure on prices. So, a lot of the copper stocks have had decent pullbacks, and we'll talk about a few today. But I think, this is looking really interesting, and particularly when you look at the longer term, medium to longer term supply demand dynamics. We know that there's just no new major supply coming into the market. We know that demand is going to soar in the next decade. The world's going to need a lot more copper, not just for the electrification, but upgrading the grid, more power, etc., etc. We've also probably going to throw the Ukraine and rebuilding over there, which some economists have estimated it's going to cost 800 or 900 billion to rebuild a lot of their infrastructure. Of course, this is all going to require a lot of materials, a lot of steel, and of course a lot of copper. So I think there's a really interesting opportunity developing there.
Yeah, and one of our really interesting players in this space, one of the big guys is Antofagasta, and you can see that that's kind of broken out recently. Are you still positive on this stock?
Yeah, so this is really a stock that we've recommended to our UK audience, and I think Antofagasta is going to go a lot higher. It's had this nice pullback to support level at sort of 1600p or £16. It's been a nice proportional pullback from £24. Big sort of upward dynamic in the last month or so, and I think topside momentum is going to resume. So yeah, Antofagasta is a great way to play it in the UK market for those looking for a large copper producing miner.
Yeah, of course. And now moving on to another thing that's a bit more close to home is the iron ore price. I can see a few questions in here wanting to discuss that. So you think this is starting to kind of reach a bottom?
Look, I do. I think the price action is quite revealing. Despite all the negative headlines that we've seen in the business press and some of these broker forecasts that iron ore is going to break down and go to $70, that the market's going to be flooded with supply. We're yet to see iron ore prices break down. It's just established. It keeps establishing a series of higher reaction lows. That big primary uptrend that's been in place since 2016 has consistently been respected. We've seen it sort of a topside breakout above near-term resistance in recent weeks. So, what's the iron ore price telling us? Maybe it's got something to do with what's happening in China, the fiscal response that might be coming. I listened very closely to Mike Henry, the CEO. He did a great interview on Bloomberg, and he said that, things are going well in China and the demand's not falling away. So, iron ore is one to watch. The world is going to simply need a lot of steel. So, maybe what this chart's telling us that demand for steel is going to reassert quite strongly in the next year or two. And perhaps that just turns out to balance quite nicely some of this new supply that's coming on.
And with that, we're probably looking at some of those big players such as BHP. We've been sitting in this for a while. I'm sure most people have got this in their portfolio. Are we looking at this as a potential breakout?
It's not breaking out, but it's, put it this way, it's not breaking down. We've seen this 25% correction, and BHP sort of come back to sort of $39, $40. I don't think it's going to go down below that. The only thing that would really push it down below that would be if iron ore went to $70, $60, $70. BHP is the largest producer in the space, and perhaps not the largest producer. They're like one of the top 3 largest producers, but they are definitely the lowest cost producer. So they could weather that storm. But I guess what I'm sort of reading into the chart here is that BHP could be due a significant rebound, and this is probably quite important for the Australian market. Even though BHP is listed in the United States and the UK. We saw the banks really drive the ASX 200 to record highs over the last year. That was a major engine, if you like, whereas the resources lagged. Now, if we see catch up in the likes of BHP, Rio, and some of the other larger resource companies in Australia, then I could make an argument that the ASX 200 could get to 9,000 this year, which is our base case technical target for the domestic market. So yeah, BHP, I like it not just because of the fact that iron ore is hanging in there, but also the fact that they are one of the top copper producers in the world, and that came through in spades in terms of what Mike Henry said in his interview on Bloomberg. So yeah, a lot to be excited about, and if we're right on copper, iron ore hanging in there, it may not go back to 200 a ton. All it needs to do is get to 110, 120, and for copper to break through $5, then I think we could see BHP move back to the top of its range and possibly go higher and beyond that over the coming year.
And I'm sure a lot of people would be very happy with that. Now, you mentioned earlier that we've seen this kind of movement from the US and into some of these other underperformed markets that have been kind of playing catch up. Now, you've been talking about the FTSE quite a while, and is it still looking like good value?
Yeah, the FTSE 100 is it's worth highlighting this index because obviously the DAX has broken out to record highs, the Euro Stocks has broken out to Euro highs and new highs. The FTSE 100 is also hitting record highs, and that's despite the fact that the UK economy has been battling a number of headwinds, on a number of fronts in terms of its economy. So yeah, look, I'm quite bullish on the UK. I think the FTSE 100 in terms of valuations has got down to a very low level where it's probably not going to go lower. So it could be multiple expansion that drives the FTSE well up through 9,000 this year. I also think that we're going to see a lot more M&A within that space. So and also, the fact that a lot of those big resource companies, BHP, Rio, are quite important constituents. So, what could drive the ASX 200 higher is also applicable to the FTSE if we see those resource companies begin to move up in the year ahead.
Yeah, and then look, expanding a little bit wider out into Europe. I know we've seen all this talk about the Ukraine war, and as you've said, the requirement for resources there. So we thought we'd just throw the Euro stocks up here. Thoughts on this?
Well, I think the Euro stocks has really been running on the fact that a lot of European companies are actually doing quite well. Valuations are extremely cheap. And we're in a rate cutting cycle. Don't fight the central banks, don't fight the Fed when they're easing. It's always good for the stock market. So that's been encouraging. But also, if we get a peace deal in the Ukraine, I think that'll probably prove to be quite positive for the Eurozone and indeed the stock market. It might mean that cheaper gas starts to come back from Russia, so it could help out on the energy front. But we'll probably also see increased government spending by respective governments in Europe, as they up as a percentage of GDP in terms of what they spend on the military and defence. It certainly looks like it's that the government spending is going to be headed in that direction. So that's going to be good for the economy, and it's going to be good for the stock market.
Yeah, we have seen some of those defensive stocks in Europe be really big drivers, such as I think it was Rheinmetall that I saw that's been on an absolute tear. Now, we've covered resources. I thought we'd move back to the local markets, the ASX 200, and if all of those tailwinds such as copper and the iron ore price go on, we're looking for that to be the next kind of big driver.
That's right. Think of it as a jet aircraft with two engines. We've been flying on one engine. We could see a bit more backing and filling, but the breakout level at 7,600 was pretty defining. We've seen our market battle high interest rates. We're now in an easing cycle. That's going to be positive. And I think the ASX 200 is going to grind higher this year towards our target. But what we really need to see is for the resources to come in now and do some of that heavy lifting. To date, as I mentioned earlier, it's been a lot of that heavy lifting's been done by some of the industrials and some of the banks. But I expect the resource sector to provide the lift this year. Valuations are screening cheap. And of course, we are bullish on commodities. We've got this sort of secular bull market thesis for the commodity sector itself. Rising commodity prices will be good for Australia. The caveat is we've really got to see China come through with that fiscal stimulus, but that is our base case, and that's what we're looking for. So if we're right, the resources will provide that next tailwind for the market.
Yeah, and we've seen the tech sector in Australia even be performing quite strongly. One of the things that I'm sure everyone's seen in the news, and we thought we'd touch on, is WiseTech, and there's been quite a lot of developments since Monday. Are we thinking these are positive, and this is still a good opportunity?
Look, it's not good good in terms of corporate behaviour, in terms of what's happened, and I'm not going to go into that on this on the webinar. But these things have a habit of blowing over, and you know, then you look back and it's like a storm in a teacup. You know, hopefully the incumbent management have learned some valuable lessons and work towards sort of correcting it. You know, obviously we need to see an independent board reappointed, but underlying that is a very, very robust business. You know, it's got great margins. It leads in its category in terms of logistics. It's got a very, very strong business with a history of delivering. And so all things being equal, you know, technically the stock is obviously broken down through a significant support level, but it's now back at its primary uptrend, which has been in place for a few years. So I anticipate that to hold, and provided the company can get back on the path of good sort of corporate governance, then we should see the stock stabilise and let the dust settle, and you know, we should see a decent recovery over the next few years. It's a classic case of you know, buying a stock that's a great business at a much fairer price, with you know, not major secular headwinds that have buffeted it. You know, a lot of the issues, put it this way, Matt, it should be perfectly capable of being addressed fairly quickly, I would have thought.
Yeah, 100%. Just getting their governance under wraps and started to sort that out. I mean, especially as a publicly listed company, that's going to be front and center of everyone's mind. But yeah, luckily underneath that, the business itself is very strong. Now, look, Angus, I thought I'd finish off on one of the darlings that we've been on for a long time, which is Evolution Mining. It kind of gives us exposure to a number of those different sectors we've touched on today. Do you think this is still going to continue to run and it's a strong player?
Well, you know, it's up at those record highs at $6.50. You know, the technicals will always point to consolidation now being needed. So, you know, I think that you know, this is probably going to cap the price in the near term until there's a new catalyst, and the catalysts are obviously a higher gold price, but also copper, because you know 30% of Evolution's revenue now comes from copper. They made that timely North Park acquisition a few years ago, and you know, I think that will prove to be quite a prescient move by the management team. But yeah, Evolution is one company that we like because you know they've got low political risk. You know, a lot of their mines are in either North America or Australia, so there's low political risk, and they've got that mix of copper to their portfolio, which I think is which sets it apart from a lot of the other pure play gold producers. So, you know, a couple of potential drivers. So this would be one stock that I'd be accumulating. And you know, they had a great result, a really good result, which is what's helped the stock get up to those record highs. And you know, I think at some point this year, you know, Evolution's going to break through those record highs at $6.50 and move up to a new trading range.
Yeah, so that'll be interesting to see. I'm sure many of our members are holding that. Now, look, thank you for that, Angus. We're just going to finish up now with some Q&A. Now, I've got a few questions here from people. So one of the first ones is what are your thoughts on Paladin at the current levels? I know we've spoken about that last macro webinar, but I thought that might be worth touching on.
Look, it's volatile. I'll definitely concede that one. They've had some sort of mine-specific issues which has sort of knocked it around a bit. But you know, it's hard to get bearish on the uranium thesis. Nuclear energy is not going away. In fact, I think you know it's just going to accelerate around the world. Many countries just have no other option other than to go with nuclear. So, you know, I think, you know, that's got to be good for contract uranium prices, which, you know, I see in a sort of a secular bull market. Yeah, so look, over the medium to longer term, very bullish on uranium stocks. Paladin's certainly one way to play it. You know, we've got that in our portfolio. If investors don't like the individual stock risk and volatility, they can go for an ETF, which is listed in Australia, but also in the States under the codes of ATOM and URA.
Yeah, they're great ones. We've got those in the portfolios. If anyone wants to have a read of the report, ATOM you can find there. Now here's another good one. It's so what are your thoughts on ASX REITs, considering the the recent interest rate coming off?
Yeah, I think they're looking really good, particularly some of the REITs that are exposed to commercial property. We're in a rate cutting cycle. The behaviour this week in the good behaviour, I should say, this week in the US bond market is encouraging. And it certainly, you know, strengthens the case for rate cuts in the US, but also the inflation numbers here probably give the RBA more room to move later this year with more rate cuts. So that's got to be good for the property cycle. I'll just talk a little bit about commercial office property. Obviously, data centers have run really hard. So, you know, the likes of Goodman Group, which we own in our managed account portfolio, you know, we're still there, and we still think that looks good, but I wouldn't be running out to buy that today. I'd prefer, you know, some of the office-based REITs. You know, commercial office has done really bad. We've had the work from home and the pandemic situation really knock commercial office around. But I think we're through the bottom of the cycle and better days ahead. And of course, with interest rates coming down, that's only going to strengthen cap rates. We look at vacancy rates. They're probably also going to come down. There simply has not been any new office supply planned to be built since before the pandemic. So the cranes that we see in the CBDs, those are projects that were green lighted before the pandemic. So if anything, you know, the office market will tighten up. But generally speaking, you know, quite positive. I think the retail REITs also looking pretty attractive. You know, that we know that the consumer discretionary spending in Australia has been under pressure with the tight monetary policy. We're looking for that to unwind as well as the RBA eases. So yeah, quite bullish on REITs looking out this year.
Okay, well, thank you for that. And look, I'm conscious of time, so I'll just got one more for you then. We've just had someone to ask if you could comment on the Russell 2000 at the moment.
Yeah, it's come off the boil a little bit. You know, we've seen that volatility. You know, I think there was a lot of exuberance with the Russell 2000, and it probably overreached and became a bit overbought in that post-US election. So we're sort of seeing that consolidate. But look, quite bullish. I think, you know, the Russell 2000 offers exposure, you know, to the smaller sector in the US in terms of corporate size. They're obviously a lot more sensitive to interest rates. So interest rates are going to go lower in the US. So I think that's supportive for the Russell 2000. So technically, it's had a fairly steep pullback, but it's come back to its sort of primary uptrend, which has been in place since the beginning of last year. And I'm looking for it to find support around that 2150 level and resume to the top side. The Russell 2000 has to move higher for the US bull market to remain intact. And, you know, we talked about rotation. I think that's going to continue. And obviously, a lot of those small mid caps are screening quite cheaply in the US at the moment, you know, as does the other 493 companies in the S&P 500.
All right. Well, thank you very much for that, Angus, and thank you everyone else. I know this is we're running right to the edge of our time right now. So as always, we really appreciate everyone who's come to join us and the questions and the engagement. And Angus, again, thank you very much for all of your insight.
Thank you.
All right, guys, enjoy the rest of your week. Bye-bye.